Welcome to the Virginia Civics and Economics Lecture Series. At the end of each slide, there will be a 5-second delay. Use this time to complete your notes. When you are done, push play and move on to the next slide. This presentation will begin in 5 seconds. Welcome to Virginia Civics and Economics Lecture 5.8 on how the government controls the economy, and it's time to talk about the Illuminati. You know, the people who control everything. Wait a minute. What does it really mean, the word Illuminati? Well, it's plural of the Latin illuminatus, which means enlightened. Thanks, Wikipedia. Well, if the Illuminati's not in charge, then it's gotta be these guys, the Masons. You know, there is no conspiracy. And if you don't think it's the Masons, then it's obviously the secret society of happy people. None of these people are in charge? Well, who's in charge of our economy? It's these guys, the United States Federal Reserve System. Who? What is the role of this relatively unknown part of government? And how does this unelected body of bankers control the economy? Well, today we're going to answer those two questions, and with that said, let's go to the next slide. The Federal Reserve is quite possibly the most misunderstood part of American government, and rightly so. Not only are they playing with our money, but many of us don't even understand how it all works. So let's figure out the Federal Reserve. The Federal Reserve, or the Fed, is the central bank of the United States. This is company headquarters, but not everything happens from the central bank. Instead, there are 12 branches of the Federal Reserve Bank, and they are located in different parts of the United States. So here is the New York branch of the Federal Reserve. And here's what branches do. The branches provide currency to private banks as needed by the economy. What does that mean? A bank is running low on money. They want to give out more money so that they can loan it to other people, and they'll say, Federal Reserve, please loan us some money. The Federal Reserve loans them that money, but it needs to be paid back to the government with interest. Also, the bank itself loans to and acts as the deposit bank for the federal government. So when the federal government needs a loan, they get the loan from the Federal Reserve. And when all that money comes in from taxes and fees, it all goes to the Federal Reserve. As you can imagine, all of this is a little crazy for some people. For example, the Federal Reserve Bank. Even a caveman knows it's privately owned. No, the Federal Reserve is a part of the United States government. But the Fed is an independent body, free of political pressure. It essentially acts as an independent fourth branch of government, and it's co-equal to the presidency and Congress, so it's really powerful. But there are some checks. The checks are as follows. Board members of the bank and its chairperson, known as the leader of the Fed, are appointed by the president with the advice and consent of Congress. And the chairperson regularly testifies in front of Congress. So, the Federal Reserve is part of the federal government, and it's a very powerful part of the federal government. Go to the next slide. So now we know the Fed is part of the federal government, and it's a very powerful part of the federal government. So what does the Federal Reserve actually do? Well, to understand this, we're going to start by looking at the Federal Reserve and money. The Fed maintains the value of our national currency, the almighty dollar, by issuing banknotes that set forth monetary value. $1, $10, $20 and up. All of those monetary values on our dollar bills, they're set by the Fed. But here's the other thing. When the United States government issues coins and currency, people accept it in exchange for goods and services because they have confidence in our government. What do I mean? The only difference between these two notes is your belief that one has more value than the other. So the Fed has to make sure that you believe there's more value in that dollar bill than in that monopoly bill. And here's how they do it. Confidence was once created by connecting the value of currency, the dollar, to the value of gold. This was known as the gold standard, but we've gotten away from this. Now, confidence is now found in how the government maintains a stable economy by encouraging economic growth, the use of the US dollar as a standard for valuing all other currencies. That's called dollar hegemony, and that is really cool. That means all the other currencies in the world compare their dollar to the United States dollar, and whether our currency maintains its value without the help of a government manipulation. Is our government trying to keep the value of our dollar up artificially, or is our economy working to keep it up where it belongs? Finally, the Fed issues three types of money in the United States. Coins, they're coined at one of several United States mints. Federal Reserve notes, currency or the dollar, that's printed by the Bureau of Engraving and Printing. And deposits and bank accounts that can be accessed by check and debit cards. Remember, deposits are insured through regulation by the Federal Reserve and the Federal Insurance Deposit Corporation, so they are essentially considered money here in the United States. Go to the next slide. The Fed's next job is securing the banks. You see, we had this thing happen called the Great Depression, and after that, people basically said, let's not have that happen again. So, the Federal Reserve regulates the nation's private banks to ensure the soundness of the banking system and the safety of deposits. What does this look like? Here's Ben Bernanke. Ben was in charge of the Fed in 2008, and in 2008, America suffered its worst financial crisis since the Great Depression. Well, Ben was the leading scholar on the Great Depression, and with help from the Federal Reserve, we avoided economic Armageddon. Boy, did we luck out! Now, the Federal Reserve also does some things to secure the banks that don't reach the level of economic meltdown status. For example, the Fed secures the way in which banks secure deposits and how money is transferred between different accounts. For example, how money is moved when someone pays someone else using a debit card. I walk into my local grocery store, I use my debit card to pay for my groceries. How does my money actually get out of the account that I have and into the account of the grocer? Because at the end of the day, all of the money in the system needs to be accounted for, and the Fed sets up the way to make sure this happens. The Fed also determines how much money must be held in reserve by banks to cover the amount of withdrawals that may be processed. We call it reserve ratios because we don't want this to happen. This is a bank run. That's when customers realize the banks don't have enough money to secure all their deposits. So now the Federal Reserve says, banks, you need to have enough cash on hand in case too many people walk into your branch and try to take their money out at the same time. Go to the next slide. The Fed's final job is controlling the economy, and this is the really cool part. The Federal Reserve manages the amount of money in the economy to try to keep inflation low and stable. Chuck Norris doesn't target inflation, he roundhouse kicks it into submission, just like the Fed. We want prices to rise or remain the same to keep our economy healthy. Well, how does the Fed do this? It prints enough money and coin to make sure that there is enough currency in the economy for it to work properly. That's one way, but it's not really that effective. It lends money to private banks when they need it, when the bank is overextended, and sets the amount of interest to be charged for the loan. How much is the private bank going to pay it back with interest? That's kind of effective. But here's the thing where the Federal Reserve is actually controlling the economy. It buys and sells government security. Remember those bonds? In order to stimulate or slow down the economy. Buying bonds puts more money into the economy and leads to a lower interest rate, more lending and stimulation of the economy. That's like stepping on the gas. Or the Fed sells bonds and takes money out of the economy, and that leads to higher interest rates, less lending and cooling of the economy. That's the Fed stepping on the brake. Here's the thing. It's an economic balancing act. The Fed has to figure out that sweet spot. How much money needs to be in circulation? How much money needs to be available in the economy so that we don't get inflation and the economy runs smoothly? That, at this point, is the most important job of the Federal Reserve. Thank you for watching this lecture, and I look forward to seeing you in class.